Hello, everyone, and welcome. Today, we're jumping straight into a topic that's always in the news and, more importantly, is absolutely critical for your GS Paper 3. We're talking about the depreciation of the Indian rupee. Getting a handle on this isn't just about keeping up with current affairs. It's really fundamental to your exam preparation. That's absolutely right. If you look closely at your GS Paper 3 syllabus, the external sector is a huge part of the Indian economy section. And trust me, questions about currency valuation, what causes it to change, and the impact it has, they're very, very common in the mains. So our goal here is to make sure you're ready to tackle anything they throw at you. Exactly. So what we're going to do is go beyond the headlines and really structure this information for the exam. We'll dissect the why, the what happens next, and most importantly, how you can frame an answer that's going to fetch you top marks. All right, let's get started by looking at some numbers. To really get a grip on what we're talking about, there's no better way than to start with the actual data. Let's look at what our source material tells us. Okay, so here's our starting point. The source is projecting that by March 2025, the rupee will be at 85.53 to $1. Think of this as our baseline, the point from which we'll measure the change. But now, look at this. The projection for just 1 year later, March 2026, is 92.76. That's a jump of almost 8.5% in just a single year. Now, that's not just a small change. It's a really significant economic signal that we need to unpack. So, what do all these numbers actually mean in simple terms? Well, rupee depreciation is just that, a fall in its value compared to another currency, like the US dollar. As we just saw, it means you'd need to spend more rupees, going from around 85 to almost 93, just to buy that same $1. Right. And in your mains answer, once you've explained what is happening, the examiner is looking for the why. That's where the real analysis begins. So now that we've defined depreciation, let's dig into the main reasons the rupee gets weaker. You'll find there are three main culprits here. First up, our trade balance. As a developing nation, we tend to import more than we export. This creates a higher demand for foreign currency, putting pressure on the rupee. Second, you have FPIs. When foreign investors sell their Indian stocks or bonds, they convert the rupees back into dollars to take their money home. This floods the market with rupees and again, weakens it. And finally, the big one, crude oil prices. We import a lot of our oil, so when prices go up, our import bill in dollars shoots up, straining the rupee. Okay, understanding the causes is one thing, but for your mains answer, the real depth comes from analyzing the consequences. Think of it like a ripple effect. How does a weaker rupee spread out and touch different parts of the economy? This impact analysis is absolutely crucial. The first and most direct impact is a term you must remember: imported inflation. It's pretty straightforward. When the rupee is weaker, everything we buy from other countries, from oil to laptops to medicines, costs more in rupee terms. This higher cost eventually gets passed down to us, the consumers, and that's inflation. This keyword, imported inflation, is pure gold for your answers. And what about investors? What does this mean for the markets? Well, it's a bit of a mixed bag. For the stock market, or equities, a falling rupee can create some negative feelings, but it's not usually a direct trigger for a crash. But for the bond market, or debt market, the impact is much, much clearer and more negative. Why? Because that imported inflation we just talked about might force the RBI to increase interest rates to control prices. And higher interest rates are bad news for bond prices. It's all connected. Now, a really great answer doesn't just look at the problems. It also looks at the other side of the coin. So, does anyone actually benefit when the rupee weakens? Yes, two groups mainly. First, if you own gold. Gold is priced in dollars, so when the rupee falls, the value of your gold in rupees goes up automatically. Second, if you have global investments. Say you invested in a US company. When you bring your profits back, your dollars convert into a lot more rupees, which is a great bonus. All right, let's get to the most practical part of this discussion. We have all the pieces of the puzzle, we have the knowledge, but how do you put it all together in the exam hall or, even more nerve-wracking, in front of an interview panel? It all comes down to structure. Exactly. Imagine this question is right there on your paper. A well-structured answer is half the battle won. It tells the examiner that you have clarity of thought. So what is the ideal framework? How do you build that perfect answer? Here it is, a 5-step model. It's almost foolproof. 1. Start with a crisp, clear definition. 2. Explain the causes we talked about, the trade deficit, FPIs, oil prices. 3. This is the core. Analyze the impact on everything from inflation to investments. 4. And don't forget this, you must talk about the policy response from the RBI and the government. What are they doing about it? And 5. Wrap it all up with a balanced, forward-looking conclusion. Follow this roadmap and you're setting yourself up for a very good score. And here's a pro tip for you. If you want to make your answer stand out from the thousands of others, use specific, relevant keywords. For instance, the source material we're looking at mentions the Liberalized Remittance Scheme, or LRS. Dropping in a term like this shows you've gone deeper than the surface. It can definitely help you grab those crucial extra marks in both prelims and mains. So, we'll leave you with one final question to ponder. This is the kind of thing an interview board loves to ask, to see how you think. As a future policymaker, what long-term reforms would you suggest to make the rupee more stable? Think bigger than just day-to-day management. Think about structural changes, boosting exports, building our manufacturing sector, reducing our dependence on imports. This is how you shift your thinking from just being an aspirant to being a future leader. Keep that mindset. We'll see you in the next explainer.